You're not rich because you're saving. You're rich because you're investing. And I'm about to show you exactly why. Most people, when they get their first paycheck, open a savings account. They put their extra money there, and they wait and wait, hoping it grows. But here's the problem. A traditional savings account pays you between 0 and 1% per year. Let me put that in perspective. If you put $10,000 in a savings account at 0.5% interest, after 20 years, you only have $11,000. You made just $1,000 in 2 decades. But here's the real problem. Inflation in the US averages 3% per year. That means your money is actually losing value. Your $11,000 can buy less than your original $10,000. You're not staying even. You're falling behind. That's why saving is not enough. That's why the wealthy don't just save. They invest. The wealthy do something different. They invest in index funds. Index funds are basically a shortcut to owning pieces of hundreds of companies at once. An index fund bundles together hundreds of companies into one investment. The S&P 500 index fund, for example, gives you ownership in 500 of the biggest US companies, all in one fund. The S&P 500 has returned approximately 10% per year on average over the last 30 years. 10% per year. Compare that to your 0.5% savings account. Let's do the math. Same $10,000, but invested at 10% per year. After 1 year, you have $11,000. After 5 years, $16,000. After 10 years, almost $26,000. After 20 years, $67,000. Here's the comparison. 20 years, same starting amount. Savings account, $11,000. Index fund, $67,000. That's a difference of $56,000 in the same time frame. That's not luck. That's compound interest. Albert Einstein supposedly called compound interest the 8th wonder of the world. Here's why. Your money doesn't just grow. Your growth also grows. Year 1, you make money. Year 2, you make money on your money plus the original money. It compounds. It explodes. Year 1, 10,000 plus 10% equals 11,000. Year 2, 11,000 plus 10% equals 12,100. Notice the difference? You're making 10% on more money. That extra 100 is profit on profit. That's compound interest. Remember the 50-30-20 rule? Your 20% goes to savings and investments. If you make $2,000 a month, that's $400 a month. $400 a month into index funds. Let's see what happens. After 1 year, you've deposited $4,800. Plus growth, you have $5,280. That's just the beginning. After 3 years, you've deposited $14,400. But with compound interest, you actually have $17,280. You've made almost $3,000 doing nothing but investing. After 5 years, you've deposited $24,000. But your actual balance is $39,060. That means growth itself has added $15,000. Your money is now making money faster than you are. After 10 years, you've deposited $48,000. Your actual balance is over $100,000. More than double. You didn't do anything extra. You just let compound interest work. After 20 years, you've deposited $96,000. Your balance is nearly $500,000. That's a $400,000 gain. From discipline, from investing your 20%. That's generational wealth. In the early years, you're working for money. Your effort creates $400 per month. That's your income. That's your lifestyle. But look at year 20. Your $400 monthly deposit is the same, but your compound interest is creating thousands of dollars per month in gains. Now your money is working for you. You've crossed over. That's the goal. Now you might be thinking, isn't investing risky? Individual stocks, yes, but index funds are different. You own pieces of 500 companies. If one fails, you barely notice. That's diversification. That's why Warren Buffett recommends index funds for most people. The S&P 500 has crashed multiple times. 2000, 2008, 2020. Every crash, every single one, recovered and reached new highs. If you panic sell in a crash, you lose. If you stay invested, you win. Let me show you the worst case scenario. Imagine you invested everything on September 1st, 2008, the day before the biggest crash in decades. You would have lost 50% immediately. If you had just waited, just 10 years, you would have made money anyway. That's the power of time. So how do you actually start? Step 1, open a brokerage account. A brokerage is like a bank for investments. The biggest ones are Vanguard, Fidelity, and Charles Schwab. They're all trustworthy. It takes 5 minutes online. Step 2, choose your index fund. For beginners, I recommend the S&P 500 Index Fund or the Total Market Index Fund. They're the same basic strategy, just slightly different. Look for ticker symbols like VTI, VOO, or VTSAX. Step 3, automate your deposits. Set up automatic monthly transfers from your bank account to your brokerage for $100 per month. Automatic. Then forget about it. Don't log in. Don't check it every day. Let compound interest work. Common question, don't you need a lot of money to start? No, you can start with $100, $50. Some brokerages let you start with nothing and just add money gradually. The key is starting. Time is more valuable than the size of your first deposit. Here's the hard truth. $400 a month, the amount that will create generational wealth. Most people spend on streaming services, coffee, and dining out. The difference between being rich and staying poor is just discipline. choosing what you value. Your choice. Option A. Spend $400 every month on stuff you don't remember. 20 years later, you have $0. Option B. Invest $400 every month. 20 years later, nearly $500,000. It's literally the same money. Different choice. But there's one requirement. You must not touch it. Not during crashes. Not when the market drops 30% in a month. That's when your discipline matters most. That's when everyone else panics and sells. That's when you stay calm. Because you know the math. It always recovers. Now maybe you're thinking, I can't do $400. I can only do $50. Okay, $50 a month. 10 years. You have almost $13,000. 20 years, over $60,000. That's still life-changing. The earlier you start, the more you win. Start at 25. You have $500,000 by 45. Start at 35. You have $160,000. Start at 45. You only have $26,000 by 55. Every 10 years costs you hundreds of thousands of dollars. Don't wait. This isn't get rich quick. This is get rich for sure. It takes time. It takes discipline. It's boring, but it works every single time. The math doesn't lie. Compound interest is math, not luck. Remember, in the 50-30-20 budget, your 20% isn't for emergencies. Emergencies get their own fund. Your 20% is for creating generational wealth. It's for making sure you're not working for the rest of your life. Now you understand. The wealth gap isn't about income. It's about choices. It's about what you do with your 20%. Savings loses to inflation. Investing beats inflation and creates generational wealth. That's the secret. Next week, we're diving deeper into types of investments. Index funds are one option. Stocks are another. Which one should you choose? The answer depends on your risk tolerance and timeline. We'll break it down. We created a free wealth calculator that does all these calculations for you. Plug in your monthly investment, your expected return, and see your future wealth. It's free, it's interactive, and it might blow your mind. Link in the description. If this video helped you understand investing, subscribe. New videos every Monday and Thursday. We're breaking down everything from debt to real estate to passive income. Real money talk. Financial freedom starts here. Remember, you're not rich because you save. You're rich because you invest. The question isn't whether you can afford to invest. It's whether you can afford not to. Start today. See you in the next video. Real money talk.